While it still makes for good headlines and should never be entirely dismissed, the fact is the U.S. jobs report no longer packs the same punch as it once did. This is certainly true when talking about the headline components, with both the NFP and unemployment rate readings at levels that have been screaming higher rates for well over a year. And yet these are strange times we live in, where traditional fundamental market drivers have lost their swagger and cannot be relied upon as indications of where things need to be. The market is still trying to work towards the tail end of a crisis that began a decade ago, and the Fed is still trying to figure out why its efforts have been effective in certain areas only to produce little to no results in others. One of those other areas that has become the central focus of this jobs report these days is the average hourly earnings component of the data. Despite unemployment sitting just off a 50-year low and NFPs trending at a very healthy altitude, earnings have not responded, something that has been a major concern to policymakers. And yet, interestingly enough, in the current global macro backdrop of political uncertainty, global trade tension, and emerging market instability, we're not too sure the Fed, and certainly investors, will want to be seeing that earnings number tick up above forecast today. While this statement may be counterintuitive on the surface, the reality is this: if earnings come in above forecast, it will put the Fed in the more difficult position of needing rather than wanting to be moving deeper into policy normalization. That's a very big difference, and a difference that could stress out the market in the worst kind of way. Investors have no desire to be wanting to think about anything other than the compelling nature of their investments and the prospect of these investments becoming far less attractive as rates rise and the cost of financing those investments once again becomes an actual cost that no longer makes these investments attractive. And that's a scenario the Fed knows will be a big headache that it has been trying to delay, as a capitulation in U.S. equities is the type of thing that will ripple across the globe before that ripple then turns to cripple. And this is where we're at and why times have been so strange. The twist here is that higher earnings would be a positive fundamental development, but a development that also is likely to invite undesirable consequences. What's important to understand is how much disconnect there's been between the financial markets economy and the real economy. The Fed made a bet back in 2008 that it would need to implement a strategy to not only stabilize sentiment, but to infuse an artificial injection of unprecedented accommodation and stimulus that would leave investors so enticed that any talk of crisis would be long forgotten. The hope that this would rocket the market, and that amazing feeling from the euphoric record run that would ensue, would ultimately trickle down into the real economy. The point here is that the two are so far apart, as reflected through the already highlighted disconnect between things that have responded to Fed intervention, like NFPs and unemployment, and things that haven't, like how much people out in the real economy are making. And with this disconnect comes these weird dynamics in which it almost feels like one team is broken up into two teams that are now rooting for different things. At some point, this disconnect needs to be reconciled, and that reconciliation will unquestionably come when we finally do see the stock market roll over. The message here is that stocks rolling over is an inevitability, an eventuality that must be, if things are truly going to get back to a place where the global economy can stand on its own 2 feet. We've had 10 years of pause to avoid that, what arguably may have been a catastrophic result had it played out 10 years ago. Hopefully, when the play button is hit again, what ensues ends up being less painful, and a drop in stocks that takes us back to record highs from 2015 that isn't looking nearly as bad as a drop in stocks that could have taken us back to the Stone Ages. But this is where we're at here. We've had the longest 7th inning stretch of all time, and as scary as it may be, it's time to play ball again. Bringing it all back to the data, as far as those hourly earnings go, things are setting up for the data to actually exceed expectation, with the market looking for the year-on-year and month-on-month prints to come back in by 0.1% and to be at 2.8% now, down from 2.9%, and 0.3% month over month from 0.4% previously. This is where the focus should be, as any upside in the other readings won't change what should have already been and any downside will only be taken as a one-off. NFPs are expected to come in at 185K and 201K after 201K previous, and the unemployment rate is expected to drop yet again, this time to 3.8% from 3.9% previous. As far as the US dollar goes, a higher earnings print would clearly favor US dollar yield differentials and could get those treasury yields that caused such a panic earlier this week once again running up. At the same time, we would caution expectations the dollar will continue to run aggressively in this scenario, given the offsetting force of soft dollar US trade policy and separate worry that additional dollar upside could crumble already debilitated emerging markets. Whatever the case, we clearly see a lot of risk for a material downturn in global sentiment, and this sets up a scenario where what could play out is a dollar that outperforms or holds steady with risk-correlated currencies, but starts to really underperform against the other major currencies. That's all for now.